All right, welcome to The Explainer. We're going to jump into a topic that, let's be honest, a lot of us kind of push to the back of our minds: life insurance. But what if understanding this one thing, this one financial tool, could literally be the key to making sure your family is secure no matter what? Yeah, it's that important. So let's demystify it together. So let's just dive right in with a really fundamental question, something that sits at the heart of all this. If the unexpected happened, are your loved ones okay financially speaking? I know it's a heavy thought, but it is the entire reason life insurance was even invented. Okay, so at its core, what is life insurance? Well, it's really just a promise. It's a contract where you pay them, your premiums, and in exchange, they promise to pay out a tax-free sum of money, the death benefit, to your family if you're not around anymore. It's that simple. It's a financial safety net for the people you care about the most. But here's the thing. Once you decide, okay, I need that safety net, you immediately hit a fork in the road, a really big choice. And honestly, this is where a lot of people just get overwhelmed and stuck. So let's break it all down. And at choice, it really boils down to two main paths, two types of life insurance. You've got term life and you've got whole life. And trust me, they are built for very, very different purposes and financial goals. All right, so let's actually walk down these two paths and see what they're all about. The big question you have to ask yourself is this: am I looking for protection for a specific time in my life, or do I need something that's going to last for my entire lifetime? Answering that is, well, it's everything. This table right here, it's awesome. It lays out the big differences at a glance. You can see term life on one side. It's simple, it's way more affordable, and it's what we call pure protection for a set number of years. Then you've got whole life. It's a different beast entirely. It's for your whole life, obviously, and it has this extra feature, this thing called cash value, which we'll get into. So, term life. The best way to think about it is like renting. You're renting protection for a specific period when you need it the most. When you've got a big mortgage or when the kids are young and depending on you. It's designed to cover those temporary but really big financial responsibilities. And because it's so focused, just the death benefit, nothing else, it's super simple to understand. And this chart really drives the point home about cost. Look at that difference. For the exact same amount of coverage, say $500,000, the premium for whole life is just worlds apart from term life. This is probably the number one thing people notice first, and it's a huge factor in the decision, for sure. Okay, so now let's flip over to whole life. This is designed to be a permanent financial asset. It's coverage that never, ever expires as long as you pay into it. The premiums are fixed for life, which is nice, but the real game changer, the part that makes it so different, is that it builds this cash value you can actually use while you're still alive. It's a big deal for things like estate planning. Right, that cash value thing I keep mentioning. This is hands down the most confusing part of whole life for most people, so let's really unpack it. Think of it as a living benefit. It's a part of the policy that has value you can tap into while you're alive, not just after you're gone. So here's how it works. A piece of that higher premium you're paying, it goes into a special account inside the policy. It's kind of like a built-in savings plan, and that money grows over time. The really crucial part is that it grows tax-deferred. That means you're not getting a tax bill on the growth every single year, which lets it compound more effectively. And this donut chart shows you exactly where your money goes. When you make that premium payment, it gets split up. A chunk of it pays for the actual cost of the insurance and any policy fees. But the rest, that gets funneled directly into building up your cash value. It's the engine that makes the whole thing grow. Now, the cool thing is, this cash value isn't locked away in some vault. It's actually flexible. You've got options. You can take out withdrawals, you can take loans against it, you can even use it to pay the policy's own premiums if things get tight. But, and this is a really important but, you've got to remember that using this money while you're alive will almost always reduce the final death benefit that goes to your family. It's a trade-off. Okay, so we've got the basics of term and whole life down, but it doesn't stop there. You can actually customize your policy, kind of like adding options to a new car to make it fit your life perfectly. And these add-ons, they're called riders. Yeah, riders are basically optional upgrades you can add to your base policy. They give you extra benefits or protections for specific situations. Now, they usually add a little bit to the cost, but for some people, they are absolutely worth it. So let's look at a few common ones. There's the waiver of premium rider. This is huge. If you become totally disabled and can't work, this rider pays your premiums for you, so your coverage doesn't lapse.
Then there's the accelerated death benefit rider. This one lets you access a portion of your death benefit early if you're diagnosed with a terminal illness, which can be a lifeline for medical bills and other expenses. You can see how these can add some serious real-world value to a policy.
So, with all that on the table, we're back to the big question. How do you choose? Which path is right for you? And the truth is, there's no single better answer. It's not about term being better than a whole or vice versa. It's all about which one fits your financial story, your budget, and what you're trying to accomplish. And this leads us right into a classic debate you'll hear all the time. It's the buy term and invest the difference argument. The logic is simple. Get the cheap term policy for protection, and then take all the money you saved by not buying whole life and invest it yourself. Now, for a disciplined investor, this can absolutely work out great. But, it does come with its own set of challenges, like market risk and, well, having the discipline to actually invest that money and not just spend it. When you put these two strategies side by side, you really see the philosophical differences. The whole life cash value offers conservative, often guaranteed growth, it's tax-deferred, and because you have to pay the premium, it's a kind of forced savings. On the flip side, your own investment account has the potential for much higher returns, but it's totally exposed to market swings, you're going to pay taxes on your gains, and it requires you, and only you, to be disciplined enough to keep funding it. So what's the bottom line here? It all comes back to you. It's about what you want your money to do. Are you looking for a low-cost, straightforward safety net for a specific chapter of your life? Then term life is probably your answer. But are you looking for a lifelong financial tool, a multi-purpose asset that provides permanent protection and builds a conservative, tax-advantaged savings component for the future? Well, then that's the story of whole life. There's no wrong answer, only the one that fits your life's plan.